I'm Aarti Krishnan and you're watching A to Z of stock market investing. Today let's look at U for underwriting. Stock markets by themselves are very moody. Primary markets are even more so. This is why when promoters try to take their company public for the first time, like to make sure that they are doing this in good if not euphoric market conditions. What if an IPO is timed to very good market conditions and still fails to find enough subscribers to the issue? Underwriters step in these occasions and buy up the shares that are put on offer. In the US markets, typically when a company comes to the market and puts up the shares on offer, a set of merchant bankers, lead managers to the issue, offer to warehouse all the shares. So if the investors are not actually keen on buying up all the shares in the IPO, they step in and buy up these shares on the behalf of investors. They may later choose to offload these shares at an opportune time. In doing so, these underwriters can make quite a killing on the offer also, if market conditions improve dramatically between the time of that offer and between the time they actually sell it in the market. These contracts are known as hard underwriting contracts in the market context. Now in India, it doesn't work quite this way. In India, actually SEBI rules say that all the book-built offers, book-built IPOs need to have an underwriter. However, the underwriters in India are not the same as those in the US. They do not actually buy up all the shares or even warehouse them in an IPO. They actually only act as go-betweens between the company offering the shares and the investors who are bidding for them. How underwriters function in India is typically in book-built offers, we saw in an earlier video also, companies put up shares under various categories like qualified institutional bidders, retail investors, high net worth investors and so on. Some of these investors may make bids for the shares on offer, but later what if they fail to pay up their commitments? It is to make sure that such events do not happen that underwriters get into the picture in India. So underwriters actually commit to make sure that all the bidders in a book-built offer actually fulfill their obligations. They make sure that there are no delays in payment or withdrawals of bids at the last minute. If such withdrawals happen, then the underwriters step in and fulfill that portion of the IPO which has not gone through because the bidders did not pay up on time. Because of their less onerous obligations in India, Indian underwriting contracts are known as soft underwriting contracts, unlike the US where they are hard contracts. Well, SEBI rules say that if a company is unable to get at least 90% of the subscription relative to its offer size through a book-built offer, it actually has to call off the IPO. It has to withdraw the entire IPO and refund the money back to investors. Underwriters simply do not step in such situations. No. Actually, SEBI regulations require only book-built offers, the ones which invite bids through the auction route, to have underwriters. Rights offers, offers for sale, QIPs, etc. do not need any underwriters at all. SEBI rules allow any entity belonging to the market who is registered with it as an underwriter to perform this role. Otherwise, merchant bankers, investment bankers, lead managers to the issue, or even stockbrokers can sign up as underwriters to an issue. Therefore, at the outset itself, the offer document or red herring prospectus will lay down exactly how much underwriting commitment each entity has taken on. SEBI rules also make sure that no underwriter takes on obligations that amount to more than 20 times his net worth. In the stock markets around the world, underwriters are supposed to be entities who take on the risk of public offers not going through. But in India, the strange thing is underwriters themselves enjoy a fair degree of protection against the risk of an offer falling through. In a way, the soft underwriting commitments in India make it even harder for companies and promoters seeking to go public for the first time. After having their names and the offers advertised in all the papers, they have to suffer the ignominy of withdrawing the offer. Therefore, the company may end up taking the egg on the face that would have rightfully belonged to the underwriters.